margin changes, which I think would have just reduced some of the retail further. We had current initial margin at 25. That's on the COMEX 5,000 silver futures contract. Current maintenance, and then the new initial maintenance is now 32.5. And it wasn't that long ago, it was barely a week, that you were moving from 20 to 25. So you've effectively, in quite short duration. This is at their discretion, and of course they'll want to tame the market. Many people see them as co-conspirators with the banking cartel in terms of the suppression of silver markets. They took some of the sting out on the thin markets with these margin, but nothing on the big picture in terms of what we expect. We expect a 90.5 run as a interim target. We expect 333 as a full target, but not the final high. And we expect 4-digit silver in a dollar debasement, a chronic era, where the gold-silver ratio will be heading towards single digits.
Francis Hunt's latest analysis begins from a place many are uncomfortable acknowledging, that price control mechanisms in Western futures markets are becoming increasingly visible, increasingly aggressive, and increasingly ineffective. The recent rapid succession of margin hikes on COMEX silver futures is not a neutral risk management exercise. It is an explicit attempt to suppress participation at precisely the moment when price discovery is becoming disorderly. When margin requirements are raised repeatedly within days, not months, the message is clear. Volatility is not welcome. Speculative pressure must be reduced, and leverage must be squeezed out before it exposes structural stress. More importantly, Hunt reframes the silver market around a question most investors are no longer asking: which market actually sets the price? In his view, the answer is no longer COMEX or the broader Western paper complex, but Shanghai. The existence of a persistent premium in Eastern markets is not an anomaly, it is a signal. It reflects real delivery, real demand, and a market where physical metal matters more than paper representation. The result is a two-tier system where Western prices increasingly function as a discount window for Eastern buyers. But Hunt's analysis does not stop at market mechanics. It expands into a broader, more confrontational worldview that challenges political authority, institutional credibility, and the moral architecture of the current financial system. He speaks forcefully about control, coercion, and the deliberate erosion of monetary sovereignty as a means of social compliance. If you want to understand where silver may be headed in 2026, why Shanghai matters more than ever, and how Hunt connects markets to power structures, stay with us. Subscribe, like the video, and watch this analysis through to the end. We appreciate the support and hope you enjoy the video.
That will have caused a bit of chop. I would argue there's a couple of interesting things going on, and it becomes a question of which is the real market. And my opinion is that the Shanghai is now the real market for silver. It may be worth sharing the differences. There is a premium between the COMEX and the Western world's pricing, all aspects of Western world pricing versus Shanghai. And I would say also that an immense amount of delivery seems to be taking place. That's the other thing that's happened that's driven this, in that there is real. So here's the difference, in a sense, between gold's performance and silver's performance for me. Gold is the banner for the debasement of debt and fiat. And you've got out of that a catch-up year of 70%, because we've been debasing slowly for a lengthy period, and we've actually had gold and silver suppression where it wasn't allowed to catch up. It should have been linear. Every year you lose, you were experiencing 3-5% inflation. You should have had a 5% move in gold and silver. But for decades, it hasn't been like that. So here's the great gift that you're getting. You're getting catch-up moves for suppression error. The difference between gold and silver in terms of their performances is that in the silver markets, it was the ultimate suppression tool, and you had above ground availability that has now largely been far more depleted, and you have real deficits of supply that have existed for multi-years. So in the silver part of the gold market, not only are you getting the inflation debasement trade elements that has driven gold. So you start with the 70% gold has. You've also had, as a loss of trust in the Western system, you've had people saying it now matters more to physically hold and control the actual metal. So they have been increased delivery, mark for delivery component in the futures market has actually seen a massive run in you don't own it unless you hold it physically. So we've had lots of images on X of even just retail Chinese people with the very popular 16 kilogram slabs, which are 500 ounce bars. The largest standard is 1,000 ounce bar. I think I stand corrected that when they say 5,000 ounce, I think it's 5 of the 1,000 ounces is the contract. But I might be incorrect. Someone will correct me below. I'll have to double check that. But anyway, you're having a two-tier pricing system as well. So the West currently represents, in essence, a discount window for the East. And if you want to follow what direction COMEX silver or your broker in who you're trading with in the silver markets in the Western realm, what's likely to be happening, whether you're going to be going up or down. It's almost more beneficial to be watching the Shanghai price because you get the Asian session and you see what happens there. And the Western market is now following the Eastern market because the delivery market, the most aggressive delivery market, is now in the East. And that's the difference. That's the premium on top of gold. So silver starts with the 70% monetary metal debasement gains that gold has had as almost a natural, that's what they're all getting as monetary metals. And then on top of that, it's getting the actual shortage, the run on the physical shortage. Gold, less of a shortage aspect because a lot of bullion stored. Central banks hold a lot of it. They can lease it out, lend it, do whatever. But in terms of consumption, I think any place that is doing actual delivery on the highest level, as always with technical analysis, they will always say volume is an endorsement. It's like a number of voters for a certain price. If you have a very thinly traded item, I could list a family held company where me and my family members hold 95% of the equity, and we have an IPO with a very minor amount, and we let the market push it around. And at any point, we can whale in and buy up our own remaining 5%, or we can dump it. That changes the entire market cap valuation, including for the 95%. So we'll always say to you, volume, true volume is an endorsement for the price. Thin volume is not necessarily as strong an endorsement on the price. So in the case of silver, I'll say where the bulk of the delivery is taking place. That said, it would not be accurate to just say that COMEX and LBM are just paper markets, because what's actually happening is delivery is being called for there too. I'll also, while we've just got the share screen up, just show you that margin changes, which I think would have just reduced some of the retail further. We had current initial margin at 25. That's on the COMEX 5,000 silver futures contract. Current maintenance, and then the new initial maintenance is now 32.5. And it wasn't that long ago, it was barely a week, that you were moving from 20 to 25. So you've effectively in quite short duration. This is at their discretion. And of course, they'll want to tame the market. Many people see them as co-conspirators with the banking cartel in terms of the suppression of silver market. So they don't want any speculators getting hot and rich on a bank that's heftily short. There's been quite a few rumors that there were banks unable to deliver. A bank, many banks, one bank, who knows, or maybe just a rumor that doesn't have any validation behind it. So they took some of the sting out on the thin markets with these margin, but nothing on the big picture in terms of what we expect. We expect a 90.5 run as a interim target. We expect 333 as a full target, but not the final high. And we expect 4-digit silver in a dollar debasement, a chronic era where the gold-silver ratio will be heading towards single digit.
What Hunt establishes in the first section is a hierarchy of markets defined not by reputation, but by delivery. Gold, he argues, has already completed a catch-up move that reflects decades of suppressed monetary debasement, while silver is now attempting to do the same under far more constrained supply conditions. The distinction is critical. Silver inherits the same monetary tailwinds as gold, but it also carries an industrial consumption profile that cannot be papered over indefinitely. As physical demand intensifies, futures markets are being forced to reconcile paper volume with real-world scarcity. That reconciliation is showing up first where delivery is most aggressive, and that is increasingly in the East. From there, Hunt broadens the discussion beyond markets into principles, power, and survival. He moves away from charts and spreads and into a framework that views finance as an extension of political control. This is where his tone sharpens, and where his argument becomes less about price targets and more about positioning oneself intelligently within a system he believes is becoming openly adversarial to individual autonomy. The next section explores that perspective in detail, not as rhetoric, but as a lens through which Hunt interprets monetary debasement, inflation masking, and geopolitical maneuvering.
It is a spiritual war. It is a good versus evil war. And my guidance and my compass for navigating this area, it's not for me to project and tell other people how they should behave morally, but I say, determine your principles and stick to them and expect them to become harder and harder to adhere to, especially if they're noble ones. Do what you say, be honorable, be honest, be straightforward, all of these things. And I've even spoken about the duality of morality, which is how you should have absolute integrity and morality towards a fellow human who is honest and forthright to you. And you should actually be prepared to be entirely duplicitous towards institutions, governments who are quite clearly part of the inversion perversion. It doesn't help you be the honest fool at the poker table, because they're going to have all your chips and all your money. You owe it to yourself to survive. You owe it to your family to succeed here. And you should set up structures and be opaque. And you should recognize you also owe it to yourself to survive. You're not some martyr that just gets to be hammered and have all his stuff taken off him. And this is a wealth strip. It is an absolute power game. People see themselves as future demigods with power over the right to live and die and how you live and die in terms of the freedom. This is an inversion perversion game that is the world as we come. And by disarming you of valid money that people accept, they leave you absolutely victim to the wind. And I use the word disarm for many reasons, because many are being disarmed physically from ownership of firearms, but also financially disarmed and everything. They have you right where they want you, the UBI, the social score, you will comply or you will die. That's kind of how threatening these people are and how much they aspire to that power over you and that demigodness. So there's a lot going on in there. Bringing it slightly closer to the markets, you mentioned war, Venezuela, and various other aspects. They are trying to mask the inflation. So first they lied about the labor numbers. We said, as we always did, that you were in a recession during 21, 22, 23. We were talking about the recession. And now it's quite clear and obvious we're in a recession. We're talking about the next cycle. You have to be ahead of the game, not behind the game. A lot of people getting really excited now that, oh, we called a recession, let's talk about the recession. You need to be now thinking about the inflation that is the lie. The inflation is being lied because the fiat and debt debasement that gold is showing you via its sudden catch-up and the lack and loss of trust in the fiat debasement system is showing you that is seeing money flow into gold and other assets. You've just had a 70% year in gold. What does it tell you? You are in the fiat and debt debasement. Everyone talking recession, you should be concerned for your cost of living that is going to be shown and the degree of lie. So a lot of what's going on with Trump and Venezuela, more specifically in the economic front, is getting onto the heavy tar-based oils that the US is good at refining, because they are more geared up for refining that. Western Texas Intermediate's kind of an intermediate sulfur-based oil. They want the Venezuela heavy stuff because they are masking the full inflation. And the biggest tool for masking inflation is the oil price, because it's in delivery, it's in plastics, in packaging, It's in energy, it's in travel, it's in holiday season, it's in work season, it's whether you fly to meet an account that you look after as an account manager, or whether you just do a Zoom call. It's in all of those things. And the biggest call we made this year regarding gold and oil was that, in fact, it's 2 years old now, when oil was 14 barrels to 1 ounce of gold, is you want to be long gold and short oil. And that has well outperformed the gold price. Had you put on that trade, it was $87. It had hit 129, the oil price, when we said that. And the reason we say it is because you're in stagnation and stagflation, and they are controllers of the oil price. It's no surprise that it's Chevron, Exxon that want to get into Venezuela. The original Rockefeller oil components that Standard Oil got broken into. And this is, they will use war to secure it, and they will mask, they will flood. There's a plenty supply of oil, and the oil price is actually very low, indicating both reduced demand and very well supplied supply, sufficient and potential oversupply. This has stopped, to a large degree, the fullness of what they're doing in terms of the fiat and debt debasement from being as apparent as it truly is. In spite of that, go have a look at a beef chart. Go have a look at a Japanese rice chart. Go have a look at the coffee beans over the last 4 or 5 years, whether it's Robusta or Arabica, and you can't hide the debasement. But people see that less because they can say, oh, there was a drought here and there was a drought there, and then some stock got this. It's easy for the propaganda machine of the financial press to mainstream explain that away. But it's much harder when everything is going up simultaneously and the oil price is high. So by ratcheting down the oil price, you'll remember when the oil price was at its highest. It was when we were at the wealthiest. They treat the oil price as a ratchet. When they are creating lots of liquidity, and we had an absolute boom, and everyone was changing their car every 18 months and extending the mortgage on their property that had gone up by, another 200 grand, and buying another $80,000 car and extending the loan and all of that. The oil price, they skim because everybody's flush. The oil price ran 150 during that era in 2006 and 2007. And then when we had the depression, the oil price overperforms to the downside to compensate for the chronic loss of demand, to make things still viable. So it's one of the most controlled commodities in my view, and I call it the Rockefeller tax. The tax goes up when you flush because it's easy to skim, you don't feel it so much. When you crushed, they need it to go down, and because of the inflation metrics that are in that.
At its core, Francis Hunt's outlook for silver remains fundamentally optimistic. He sees silver not as a speculative trade, but as a corrective mechanism within a distorted financial system. His targets, whether one agrees with their magnitude or not, are rooted in arithmetic rather than emotion. Years of suppressed pricing, persistent supply deficits, rising physical demand, and a global monetary environment defined by chronic currency debasement. In that context, silver's volatility is not a weakness, it is evidence of strain. And the more aggressively that strain is managed through margin hikes and policy intervention, the clearer the underlying imbalance becomes. Hunt's emphasis on Shanghai is especially important for investors thinking beyond Western narratives. A market that demands delivery, enforces settlement, and reflects genuine demand will always exert gravitational pull on global pricing. The presence of a sustained premium is not simply an arbitrage opportunity, it is a warning signal. It suggests that paper liquidity is no longer sufficient to anchor price. As Eastern markets continue to accumulate physical metal, Western markets risk becoming increasingly abstract representations of value. Where Hunt's analysis becomes more contentious is in his broader critique of political and institutional power. His language is uncompromising, and his worldview assumes intentionality rather than incompetence. He argues that inflation is being masked, not mismeasured, and that commodities such as oil are actively managed to control public perception of economic stress. Whether one accepts the full extent of that claim or not, the empirical observation remains valid. Headline inflation metrics consistently lag lived experience, and monetary assets are responding accordingly. Gold's sharp repricing is not coincidental, it is diagnostic. Silver, in this framework, represents both an investment and a statement. It is a market where physical ownership still matters, where supply cannot be infinitely expanded, and where pricing power is gradually migrating toward those who demand delivery rather than promises. Hunt's insistence on principle, preparation, and self-preservation may be uncomfortable, but it aligns with a broader trend among investors who are increasingly skeptical of institutional assurances and increasingly focused on tangible assets. Taken together, Hunt's message is clear. Silver's story is far from over. True price discovery is no longer confined to Western exchanges, and the coming years are likely to reward those who understand structure rather than headlines. If you found this analysis valuable, support the channel by liking the video, subscribing, and sharing it with others who take markets seriously. Thank you for watching, and we'll see you in the next deep dive.